Good afternoon, everyone, and welcome to our presentation on the Commerce Commission inquiry into the personal banking service. Today, Elwin, Darren, Crystal, and Desmond will explore the issue of the capital regulations, the competition, and the deposit insurance premium, and how this factor affect the smaller banks compared to the major banks. Their analysis is based on the perspective of the Commerce Commission and the Reserve Bank of New Zealand. Afterward, we'll have a Q&A session. So let's start with Elwin on the capital regulations and the competition.
So capital regulations in New Zealand's banking sector require banks to hold a certain percentage of their risk-weighted assets as equity to cover unexpected losses, with smaller banks needing 16% and major banks like ANZ, ASB, BNZ, and Westpac holding 18%. Although designed to enhance stability, these regulations often disproportionately impact smaller banks due to their limited assets and distinct business models. This limits their ability to lend and innovate, whereas major banks with more extensive assets and diverse products navigate these requirements more effectively, potentially increasing their market dominance. Thus, capital regulations, while aimed at ensuring financial stability, can inadvertently stifle competition by hindering smaller banks.
Regarding the issue of higher deposit insurance premium for smaller banks, Commerce Commission's concerns are indeed valid. The imposition of higher risk-based premium could substantially affect these banks given their tight profit margins and less diversified portfolios compared to larger banks. I agree with the Commerce Commission's stance. Whilst imperative to encourage prudent risk management, it's equally crucial to ensure a balanced approach to premium. A purely risk-based premium structure may require adjustments to prevent imposing undue financial pressure on small banks.
RBNZ promotes a competitive financial environment by reducing entry barriers and diversifying services, aligning with some of the Commission's recommendations. However, it believes current bank capital rules ensure stability and fairness, with changes potentially yielding minimal benefits and unintended consequences. RBNZ supports risk-based deposit insurance premiums and easier bank account switching to boost competition. While fostering innovation, RBNZ balances stability with competitiveness, not fully aligning with the Commission's suggestions.
Having considered the insights from the Commerce Commission and RBNZ, I propose a few key recommendations. First, we should introduce a tiered capital requirement system which differentiates further based on size and risk profiles of banks. This system would scale capital requirements by absolute thresholds as well as percentages, considering each bank's total assets and scale. Second, for the deposit insurance premiums, I suggest a graduated premium system with capped annual increases. This approach would allow smaller banks to adapt financially over time. Additionally, establishing a periodic review of these premiums will ensure they remain aligned with actual market conditions and bank performance. Lastly, to enhance competition, the government or regulatory bodies should facilitate access to funding for smaller banks by providing matching funds or partial guarantees for their loans. This would reduce perceived investment risk and encourage more lending to these institutions.
And thank you to our presenters for their insightful analysis. So I've collected some questions from the audience, and our first question is for Elwin. So how do the large banks more effectively comply with the capital regulatory requirements compared to the small banks?
So large banks effectively comply with capital regulatory requirements due to advantages like broader asset bases and diversified portfolios, which spread risk and minimize capital needs. They have better access to capital markets, sophisticated risk management systems, and benefit from economies of scale that reduce compliance costs. Additionally, their strong financial buffers and influence in regulator discussions allow them to adapt to regulatory changes more efficiently than smaller banks.
Okay, thank you, Elwin. The next question is for Darren. So when setting the deposit insurance premise, aside from the risk management, what other factors should be considered to ensure that the competitiveness of the smaller banks is not affected?
Banks with higher capital ratios are generally more resilient to financial stress. Premiums should take into account the capital adequacy of banks to ensure that they're not penalized for maintaining robust capital buffers.
And the next question is for Crystal. So how can the small banks maintain competitiveness and the market position amidst large banks investing in R&D and launching the innovation products?
Small banks can maintain competitiveness by relying on regulatory support from measures like reduced entry barriers and the introduction of deposit insurance premiums. They can also focus on innovation tailored to niche markets.
Finally, we have a question for Desmond. So how would your recommendations on the capital requirement and the deposit insurance premiums specifically benefit smaller banks in terms of the competitiveness and the financial stability?
These recommendations will level the playing field by adjusting regulatory frameworks to be more proportionate to the scale and risk profiles of smaller banks, enabling them to compete more effectively without undue financial strain.
Okay, thank you to our speaker for their thoughtful response, and we appreciate the engagement and insightful questions from our audience. And thank you again for joining us.